China's housing crisis triggers global economic ripples. The ongoing housing crisis in China is sending shockwaves through the global economy, raising concerns about the implications for markets and industries far beyond its borders. The country, which has long been a significant engine of economic growth, is grappling with a severe downturn in its real estate sector. This crisis has not only affected domestic investors but also has international ramifications, particularly for developing countries and emerging markets. China's property market, once a pillar of its rapid urbanization and economic expansion, is now facing a dramatic decline. Major real estate developers are defaulting on debts, leading to a wave of unfinished construction projects and a plummeting property market. This situation has resulted in financial instability for many investors and has raised fears of a broader economic slowdown in one of the world's largest economies. The repercussions of this crisis are being felt globally. As China is a major consumer of commodities, the downturn is impacting prices for materials like steel and copper, which are critical for construction and manufacturing worldwide. Countries that export these commodities, especially those in Africa and Latin America, are witnessing declining revenues as demand from China wanes. This could hinder economic growth in nations that are heavily reliant on raw material exports. Additionally, the crisis has implications for global supply chains. With Chinese construction slowing down, the demand for construction materials and components is decreasing. Many companies that depend on Chinese suppliers may face disruptions, leading to delays and increased costs in various manufacturing sectors. This situation may compel companies to seek alternative suppliers, which could shift trade patterns and affect global trade dynamics. Foreign direct investment (FDI) flows into China are also witnessing a downward trend as investors grow wary of the instability in the real estate market. This reduction in FDI not only affects China's growth prospects but also has a cascading effect on countries that benefit from Chinese investments. Developing nations that have attracted Chinese capital for infrastructure projects may find their plans jeopardized, leading to delays and potential economic setbacks. The Chinese government has implemented measures to stabilize the housing market, including easing restrictions on property purchases and providing financial support to troubled developers. However, these interventions are met with skepticism, as the underlying issues of excessive debt and overbuilding remain unresolved. Analysts caution that the situation may worsen before it improves, and the long-term effects of the crisis could reshape China's economic landscape. Furthermore, the crisis raises questions about the sustainability of China's growth model, which has heavily relied on real estate and construction. As the country seeks to transition to a more consumption-driven economy, the current turmoil may accelerate this shift, forcing policymakers to rethink economic strategies. As the world watches China's housing crisis unfold, there is growing concern about how it will affect global economic stability. Countries that are closely tied to China's economy are particularly at risk, prompting analysts to monitor developments closely. The crisis serves as a reminder of the interconnectedness of the global economy, where challenges in one region can reverberate across the globe. In the coming months, market participants will be looking for signals from the Chinese government regarding further policy measures and reforms aimed at stabilizing the housing sector. Additionally, the international community will be keenly observing how the crisis influences China's trade relations and investment strategies, particularly with developing nations that are increasingly vulnerable to the fallout from this economic turmoil.